Welcome to the Galileo Capital monthly update for September. I'm thrilled to introduce you to one of she's a new face to many of you, but not new to Galileo, Dimpho Kiti. Dimpho's been with us for like ages now. I think for her it probably feels like centuries. And she started with us as a financial planner in training. So she's gone through her journey from doing administration to paraplanning, and somewhere along the line, very soon you'll be seeing her as a financial planner in Galileo Capital. Dimpho, thanks so much for joining us.
Thank you, Warren, and thank you for the lovely introduction. So I'll start off. Given what's been happening offshore and in the US, clients are wondering if they should still continue investing their funds in dollars or if they should use alternative currencies. What's your take?
It's a real live question now, because we've been through a time where the dollar has been really strong for quite some time. And it's almost been like a big vacuum cleaner, just sucking up money from all around the world. You see, money flowing, especially from emerging markets, away from even South Africa, China, all the way through, and as a haven of safety, being the US. And now we're in a situation where interest rates are likely to come down in the US. There's more and more concern about the impact of tariffs. And so instead of being a vacuum cleaner that sucks up all the money from around the world, we're in a situation where the US is maybe a bit neutral. Investors are looking at the dollar and saying, we're not sure. And so they look for alternatives. And if the dollar does weaken substantially over time, that's very positive for countries away from the US. In other words, we're already seeing the euro. I think it's somewhere around 10 to 15-year highs relative to the dollar already, and we might see that happening across many countries and currencies, and the rand would be one of them. So when you're in that situation, I understand the question. It's an intuitive question from our clients to say, well, if we know the dollar is weakening, why on earth are we putting money into a global portfolio denominated in dollars? Like, what's wrong with us? Why would we do that? And so maybe just to explain, when you buy a global portfolio, that means you're buying shares that are listed in America, shares that are listed in London, right through Europe, all the way to Japan, China, etc. And those shares are trading on their stock exchanges in their currencies. So you're buying a UK share in pounds in the UK. And so when you see a dollar price for your global portfolio, it doesn't mean that you've bought everything in dollars. You are buying a dollar-based investment, and then from there, dollars are being exchanged for pounds, for yen, for renminbi, all over the world. And very much like we're used to in South Africa, if the dollar is weakening and you've got a pound and a euro denominated investments inside your portfolio, it actually means you're going to end up holding more dollars, because now your euros are worth more dollars. And so that's very similar to what we had in South Africa, where if you bought Richmond and the rand went from 15 rand to 20 rand to the dollar, you actually had more rands because the rand was weaker and you were multiplying it by the exchange rates overseas. So we're not concerned about a devaluation over time in the dollar. We think that it's probably overdue, and it is a cyclical correction. In other words, the pendulum always swings where a currency might be too weak, and then over time it becomes too strong, and then it will try and action will be taken to try and correct that again. And I think we're in a situation like that, where the dollar's been too strong. It is coming back. I think I know a lot of people will say, but hang on, it's not the world's reserve currency, and people are looking for alternatives. That's great. We would love to have alternatives, but we think for quite some time, and I'm talking periods of 5, 10, 15, maybe 30 years, that the dollar is going to be the world's reserve currency, or at least one of the world's reserve currencies. And we would need a currency like the euro to be kind of much more stable for much longer before it would compete head on with the dollar as the world's reserve currency. So we're not panicking about the dollar. We think that if you've got a global portfolio, you don't want to have all of your investments in US shares, especially those shares that are, let's say, out of the top 20 or top 50 in size. So if you're in the middle of the kind of American stock market, in terms of size, then you might be investing in companies that are expensive and overexposed to the impact of tariffs. But if you're in a proper global portfolio where you've got real diversification, which is obviously what we're doing, Dimpho, like we don't just take all our clients' money and chuck it into the Magnificent Seven and hope for the best. We're invested across the globe, and always, we would say half in an index, half in active funds, and the active money that we've allocated to fund managers is generally in value shares, and a lot of the value that they foresee in the world is not in America; it's out of America. So we're not complacent. We obviously watch the stuff carefully. But we just want to say we don't think that that's a reason to move out of a dollar-denominated global portfolio. And in fact, when the rand's sitting at 17.50 or whatever it is to the dollar, and you're looking to build up your global exposure, if you're not at your structural offshore allocation, it's not a bad time to take advantage of a strong rand, weak dollar, and get that global exposure. I think it's, as always, when the rand is strong, we shouldn't be complacent. That's the time we should be buying dollars, because we know the cycle will turn again.
That was going to be my next question, whether the clients should take advantage of the weaker dollar and send money offshore. Do you think they should continue to phase in, or should the phase-ins be longer or shorter?
Yeah, it's a great question. So I think if you're actually sending rands into dollars overseas, then I would buy the currency at once. In other words, at 17 Rand 50, if you've got 10 million Rand to allocate to dollars, I would convert that into dollars immediately. Somewhere around that 1740 to 1760 level, I think is a very good level for the Rand. But on the other side, once the dollars are now bought and you're now committing money to the global markets, you can certainly phase that in over a period of months. Having said that, if you're going to use a global feeder fund, and just to explain that jargon quickly, that means that you're using rands, you're keeping them in South Africa. So maybe you're buying it in a tax-free savings account, or you're doing it via your trust or your investment company, then I would say I would probably do that as a lump sum now. I would take my lump sum, buy the feeder fund at once, and simply because the exchange rate's good and we wanted to capitalize on the exchange rate, and then on the other side, the money that's invested in the value shares and the value sectors of the global economy, you would be buying those at a good price. So phase in. When you've got dollars and you're feeding it into the global markets, but if you're converting rands to dollars, do the lump sum now, and into feeder funds, I would also do that lump sum now. If you feel uncomfortable with the volatility, some of our clients are quite risk averse, then maybe you shorten that phase into 3 months or so. But I definitely wouldn't take a 12-month view on phasing rands into dollars now.
Okay, good to know.
It's now my turn, Dimpho, and one of the things that's going on right now is we're listening to phenomenal amount of noise, and I use that word on purpose, around the world. So we've got Trump, doing late night tweets. I'm sure it's from the bathroom on his Truth Social and social media going crazy, and then a huge amount of noise and kind of real human tragedy happening in the Middle East, all the way through to the Ukraine, and lots of conflicts going on. And then add the tariffs that Trump's waving around. There is a lot of news, but also a lot of noise happening now. And I just wonder, what does that do when we look at our clients' portfolios and the returns that they're seeing now?
No. From what we've noticed of late, clients' returns are still quite positive. So what's happening in the news and what we're hearing is not necessarily reflected in the returns that the clients are getting. So it's either there's a lag in the market or one just needs to simply filter out the real news from the noise that's out there. And of course, we can't necessarily say how long this is going to last because we don't do market predictions. So it's really important for clients to just filter out the real noise from the real news, and honestly, to just be careful of what they take in.
I mean, I must say, from my perspective, I mean, one of the things to do actually, if you're listening to this and you're wondering how you stay calm, I mean, part of the thing is stay calm by avoiding a lot of the noise. There is almost nothing an investor can do about conflict in the Middle East, conflict in the Ukraine. We can't do anything about Trump's tariffs. So exposing yourself to daily, even weekly updates around what's going on those, and there are big events, and some of them have an enormous human toll. There's a huge cost to what's going on in the Middle East. But from an investor's perspective, you have to make long-term, and I'm 10, 20-year, 30-year decisions. And so, trying to kind of consume all the news and listen to all the stuff that's going on, especially on your WhatsApp groups and on social media, I think adds no value. It doesn't add value to your life. It certainly doesn't add value to your ability to kind of stabilize and find a happy equilibrium as a human being. And from an investment perspective, no news. It's no valuable information there. So, with something like tariffs, we are watching tariffs closely, and we think it's an important thing, but we're not going to react to announcements that are loud on social media. When Trump says 50% tariff on India, what we are going to do is we're going to look at the terms and conditions, which get published weeks, months, and possibly years afterwards, because it's in the detail that you find out what goes on. The 50% tariff might end up being on basmati rice imported to Ohio and actually have no impact on the real big volumes of trade that happen between the US and India. And so in something like that, we would pay attention, but we're to pay attention to the detail, not the headlines. And I think, understanding how the media machine works, the headlines are designed to draw your attention. They're designed to provoke emotional responses. And unfortunately, they're not generally designed to provoke happy emotional responses. They want you to be afraid. So in that instance, the best thing I could suggest is stop reading that stuff. It doesn't help you. Stick to a strategy and just know that the money that we've allocated to investments, number one, is correctly diversified to compensate for a lot of what's going on. And number two, you're buying, when you buy a share like Microsoft, you might not be buying it directly, but the likelihood is in a global portfolio, you own Microsoft. If there are tariffs and if there are big trade wars, et cetera, the executives at Microsoft are not just sitting in Washington State near Seattle, kind of just doing nothing and twiddling their thumbs. They're adapting and they're adjusting their business case to deal with the global environment, and they're doing it in real time with real data. And so it's not our job to second guess Microsoft. It's our job to say, is Microsoft at a fair price? Is it a good business to buy? Then let's buy it, and we trust the management team to navigate the complexities. And that happens across all of these businesses right across the world. So again, it's not that nothing's happening, but I just want to urge our clients and the other people that are watching this to say, a lot of the time, by the time we know the real information, the market's already moved in one direction or the other. So we don't have a crystal ball, like Dimpho said. And if we did have one, I promise you it's been broken for the last 20 years. We've never managed to predict anything accurately except one in every 2 rugby games. And so let's not waste time on something which no one can do, which is forecasting. Let's rather focus on long-term strategy, and that seems to work very well. So Dimpho, I must say, if I look at our agenda and the talking points that we agreed, there is nothing else on my list. And maybe just to say, I think where we're in an environment like we are now, I know some of our clients would say to us, we do a lot of kind of new ways of saying the same thing in our monthly updates, that there's a bit of repetition. I don't think that's a bad thing. And I'd hate to apologize for being consistent, because I think consistency in the way that you look at money and the way that you make decisions in a crazy and volatile world is correct. That's what you look for, is sensible, rational decisions when the world is going crazy. And certainly we're in a time where I think if we had to give the state of the world kind of a label at the moment, it would be named after a British sitcom called Men Behaving Badly. And that's where we are now. We've got a whole lot of men, some of them in their 80s, behaving very badly right now and doing their best to upset the apple cart. And we think the world will adjust. The world will get used to what's going on, and markets will come out the other side. And then to your point, the news and the noise isn't reflecting in market growth. We are seeing very good market growth, and we're not complacent about it. We're grateful, but we think that trend could well continue if interest rates come down. So unless you've got anything else, Dimpho, I think we can wrap up.
Yeah, as you said, sometimes clients just need a gentle reminder to stick to the strategy, to do the things that they already know, but just to give them that extra backup that they're on the right path.
So well done, Dimpho. I know you were looking forward to this like a hole in the head, but you did very well. And looking forward to doing many more of these with you, and to our listeners and our clients. Thank you very much for watching, and thank you very much for supporting. We'll be back with the October updates again.